Hey everyone, Ty Lasater here with Lasater Capital, and welcome to this 14th episode of The Growth Factor. We're going to do something a little bit different this time. So, I've been getting a number of questions here recently, or potential investors looking for clarity around what exactly is a preferred return. So, I'm going to break that down, but I'm also going to use a couple of articles that I read over the last couple of days about the market, the financial market, about real estate, and then I'm going to overlay those articles or really a preferred return and what our investments look like as it pertains to those articles. And so I get a bunch of people asking, around a preferred return. They think that it's an interest rate or a dividend or some sort of guaranteed distribution. And so I want to be very clear about what exactly a hurdle rate is or a preferred return. And what it ultimately does is it creates alignment between passive investor and the manager of the fund or the assets. And so at Lassiter Capital, myself and my brother, we invest directly into every one of our funds. So just like our investors, we put our capital into the fund, and that capital is treated the same as every other investor. So we're essentially an LP in the fund, and then we're a GP in the fund or the manager. And we do that for a couple of reasons. Number one, we like the deals that we do, and I want my money working for me just as each of you do as well. But number two is alignment. Many operators or managers don't invest directly in the funds that they have. They may invest in the project, but they do it separately and their money gets preferential treatment. And ours, we want that working alongside all of our investors. And it allows me, puts me and my brother into a mindset so that we can think from an investor's perspective as well as from the manager's perspective. And then we can look at the big picture when we're making decisions on how any decision impacts both of those aspects of the investment or both partners ultimately involved in the investment. And so, really, then a preferred return is another tool added to that to create alignment. What I mean by that is a preferred return. I'm gonna break it down. It's often uh, said as a pref rate or a hurdle rate, and I think hurdle rate best describes it. It's a hurdle or a benchmark that the fund has to produce to the investors before the manager starts earning income. And what I mean by that is I'm going to use our current fund as an example. So we have multiple classes in our fund, depending on what an investor comes in at. Depending on how much capital they invest in the fund, puts them in different classes. And one of the classes, we have a class that's reserved for our institutional investors, $5 million plus. Okay. And so at that class, when one of the institutional investors or extremely high net worth investors comes into our fund at $5 million or more, they get a 14% hurdle. So, and then a 90-10 split of profits. So their preferred return is set at 14%. And what that means is they on the money, let's say they invested $10 million. Okay. So on that $10 million, they are owed $1.4 million or 14% per year before we get any split of profits. Okay. And so the way that works, typically when we buy assets, they're definitely not going to cash flow at 14% from the onset. And they may not ever cash flow at 14%. I've had some that cash flowed as high as 12, almost 13%, like 12.7. Okay. It's not typical. Typical is in the first year, 2 to 4% while you're doing value add. And then it grows from there. You'll see 4 to 6 maybe in the second year, 6 to 8 in the third year. And that's kind of where it hits and caps for the life of the investment. Okay. And so with the hurdle rate, an investor that invested $10 million that's owed $1.4 million before we see profits, well, in that first year, they may get $200,000. Okay. That means they're still owed $1.2 million from that first year before we get to participate in the profit split, that 90-10 profit split. Okay. So moving into year two, they get $600,000. So they're still owed 1.2 from the first year. And now they're owed 800,000 from the second year. Okay. And so then let's say for ease of math, years 3 through 5, it did cash flow at 14%. So 1.4 million. Okay. They're owed 1.2 and 800. So they're owed $2 million from years 1 and 2 at the sell of the asset. Okay. So when we sell the asset, they'll then recognize that additional $2 million of cash flow from years 1 and 2 that they didn't get. Then they'll get their $10 million back. Okay. So now they've gotten their capital back, their $10 million. And this holds true as well with a refinance, which is typically how we're looking to exit an asset. Instead of fully selling the asset, we want to refinance the asset so that we maintain cash flow, but we get our capital back out. Okay. So now they've gotten their capital out. They've gotten $1.4 million per year. And then everything over and above that is split 90% to the investor and 10% to us. So that preferred return or hurdle rate creates a working relationship, and it creates a incentive for the operator to execute upon in order for them to earn out and start earning income. Okay. So if for example, an investment doesn't hit the preferred return. Okay. Let's say that for some reason the investment, I'll use the last 3 years as an example. The last 3 years where we've had an extremely tough economy, where we've had interest rates climbing exuberantly, it eats into the profits. Okay. And so then you're going to have investments that may not meet the preferred return. They may meet, let's say the preferred return was 10% and they only hit 8% per year. Okay. That means the investor is going to get their money back and they're going to get 8% per year. And the manager isn't going to get any earnings in that example. Okay. And so it creates a working relationship with an incentive built in. Okay. And so that's exactly what the hurdle or the preferred return is meant to do. And furthermore, like I said, with our investments, we add in the fact that we invest alongside the investors. Okay. So I put $1 million into one of the funds. I'm getting the same treatment, my capital is working the exact same way as all the investors that are in that fund are. Okay. And so I read a couple of articles over the last couple of days, and I want to, number one is really pertains to the financial market, but I'm going to correlate that and how it impacts our investments and what we're looking at in the near future. And we've got a very small window of opportunity over the next, I'm looking at 9 to maybe 18 months. Okay. So we've got 9 to 18 months of a window of a buying opportunity in real estate. Okay. And so this is going to be an opportunity of a lifetime. I think it's going to be a better opportunity than the 07-08 subprime crisis, which it did impact commercial significantly, but it had more of an impact on single family. Okay. This time around, and I'm going to get into one of the articles as to why, we're going to see a huge opportunity in commercial and specifically in multifamily for operators to step in and take advantage of foregone equity and negotiating power with lenders that are looking to get loans off their balance sheet and are willing to take discounted payoffs for those. Okay, so first, I want to go back to an article that I read in the in Fortune. Okay, and so this is an article that was written and quoted. It was really Rob Arnett ran it, and so he's a top strategist for a research firm that does $200 billion worth of research for Schwab. Okay, and so Arnett is estimating that the S&P will only return 3% annually for the next 10 years. 3% annually. Okay. The consumer price index, the CPI inflation is expected to be 2.4%. Okay. So you're not even outpacing inflation. And then when you take tax effect of your growth, you're ultimately losing value in your money in the stock market over the next 10 years. Okay. So stocks generate a return in three ways. Okay. And you can compare that if you're looking to compare, apples to apples on how we look to generate returns as it pertains to private equity and real estate. I have four ways that we focus on. Okay. With stocks, it's dividends, which right now the dividend yield is setting at 1.2%. So you invest $100,000, you're going to be looking at $1,200 a year in dividends. So that's virtually zero on cash flow. Okay. Then earnings growth. How much is profit going to grow? How much is earnings going to grow over the life of the investment? And then you apply that to the price per earnings, okay, or the PE ratio, which is the multiple on the valuation of the stock. Okay. And so when you combine the growth of stock plus a multiple earnings, you see extremely large growth in the stock market, which is what we've seen for the last 10 years. Really, from 2016 until now, we've seen extremely large growth because of those two factors. We've seen the PE ratio, okay, the PE ratio has grown by over 11% per year. That's absolutely unheard of, okay? So you compare those three, the dividend, the earnings growth, and the multiple growth to real estate, okay? So in real estate, I don't even look at the multiple growth, okay? Or in real estate, it's called the cap rate. I assume that the cap rate is actually going to get higher after we buy it, or the value is going to go down because cap rate is a percentage and you divide income by that percentage to get your value of the asset. So if you're buying at a 5 cap and selling at a 6 cap and your earnings stayed exactly the same, the value of the asset's going to go down a little bit. Okay. So I assume in real estate that the cap rate is going to go up, which means the value is going to go down of each dollar that is yielded from income. Okay. So the focus has to be growing the income dollars. Okay. And how do we do that? So you've got 3 in stocks and 4 in real estate. The first one is equity. Okay. I want to buy an asset. If I'm going to buy an asset, I'm going to be buying that at a discount on the front end. Okay. With a stock, you're paying face value for it. Okay. Whatever the multiple is, you're paying that multiple. Okay. With real estate, you can buy the income at a discount. What allows you to do that? Well, number one, right now is the most opportune time to do that because of what I just said, that we've got banks that are taking assets back. And I'm going to get into an article here in a little bit about that. Banks that are taking assets back, or we've got really operators that are just so exhausted that they can't even keep up anymore. Okay. They're just throwing in the white towel and quitting. And they're walking away from their equity and they're leaving these assets on the balance sheet of the lender with no solution. So the lenders, the banks, have started calling us looking for a solution. They say, I want this loan off of our balance sheet. Fantastic. I'll be interested. But if you've got an asset that the operator paid $14 million for, put another $1 million in it, they're in it at $15 million. The operator's walking away from that $5 million, and lender, you've got a $10 million loan. I'm not paying $10 million. I'm negotiating that loan down to 6.5 or $7 million. Okay. And so now I'm getting an asset at a discount. Okay. And that asset, with our value add put in it, with stabilizing the asset, that most of these are below stabilization. Their occupancy rates are compressed down, or maybe their occupancy rate is high, but they're way below market on rent. Okay, so we're going to step in and we're going to immediately recognize that value growth. Okay, so buying an asset at $7 million that day one is worth 12 million, and once we're done with the business plan is worth 17, 18 million. So with that, okay, the second aspect is appreciation. Okay, how much does the market appreciate? And I'm not talking about the cap rate appreciation. I'm talking about appreciation of the population, the income growth in the area. So median household income. Okay. And so with that, you apply inflation to rent, and now you've got the ability to grow income because the population where you've invested is growing. The demand for housing is growing, and the value for that housing is growing. Okay. And so now you've got appreciation. Okay. The third thing that I look for is cash flow, like a dividend in stock. Okay. I want that to average out somewhere between 4 and 8%. Okay. Like I said, year one, 2 to 4%. Year two, 3, 4, 5, 6%. Year three, 6 to 8% is what we're looking for. Okay. So the last 3 years, we've seen little to no cash flow. I've got a couple of my funds that have had cash flow. I've got a number of funds that have not had cash flow over the last 3 years. Okay. We're setting at a time now when we can buy an asset at 55 cents on the dollar. What we can do is we can come in with lower leverage. Okay. Maybe we even buy the asset at 65 cents on the dollar. But on that 65 cents that we're paying on the value, we're only getting a 50 to 55% loan on that. So the overall leverage, the overall loan to total value is setting it around 40, 45% max. We're going to see a lot more cash flow coming off of that. Okay. So the overall return may be impacted a little bit. Okay. Because we've got less leverage. So the levered IRR is going to go down a little bit. That being said, we're buying at a much discounted price in the next 9 to 18 months. It's going to be a short window, just like it was in 07, 08. When you went into 09, it was a very short window. Short window of opportunity. You've got to take advantage of it. Okay. So what we've seen, well, and then the fourth thing that we look at for real estate is tax advantages, which obviously there are none in the equities market, in the stock market. Okay. Major tax advantages in real estate. So back to this article with Rob Arnett. Okay. So price earnings ratios have escalated over 11% per year. Okay. That is twice the long-term average, 2 times the amount of the long-term average. Okay. And so that is going to correct. And with war going on in the Middle East, and with inflation kind of maxing out, and we've addressed that now, we're facing a correction. Okay. And so the S&P multiple has gone up by 20% from the low 20s to 27.5. Okay. And so that's not sustainable. Okay. Profits have been advancing by 5 points or more than what the long-term average is. Okay. So profits have been just growing exuberantly. Okay. And like Warren Buffett always says, Warren Buffett has always said, profits can't outgrow the economy indefinitely. And that's what we've seen for the last 6, 7, 8 years. Typically, we'll see this in cycles of a decade. Okay. So we'll have a decade where you've got your PE ratios and you've got your profits climbing quickly. We've never seen them climb this fast at two times the long-term average. Okay. But then we have a decade of correction. Okay. Now that doesn't mean that we're going to go into a decade of earnings losses or of losses, net operating losses. That's not what I'm saying. I'm going to get into what that means here in a little bit. Okay. But with stocks so high, I mentioned the dividend yield is setting at 1.2%. So they're basically generating zero cash flow. Okay. So there's a law governing markets. Okay. This is just a law of governing markets that reversion to the mean is inevitable. Okay. Going back to the average. And so where we're going to see that applied is earnings and the PE ratio. Okay. The big hit is going to be the PE ratio. Okay. So Rob Arnett expects that we are going to see shrinkage in the PE ratio by 3.4 per year for the next 10 years. Okay. So that's 40% over the next 10 years. We're going to see the PE ratio go down. Okay. And then you're going to apply that to earnings. Okay. And earnings are going to creep up, but they're not going to continue going up at 11% per year. Okay. Earnings are expected to go back down to the 3% range per year in growth. Okay. So forget about losses. If you take the dividend yield and moderate earnings growth, expected earnings growth, you can see roughly 6.5% in annual returns. Okay. If you're taking in just those two things, just dividends and annual earnings growth in profit. Okay. You would expect your return to be 6.5% per year for the next 10 years. Then you apply that to the PE ratio correction of 3.4% per year coming down. Okay. So 6.5% minus 3.4, we're looking at 3.1% average return per year in the S&P 500 for the next 10 years. Okay. 3.1%. Keeping in mind, projected inflation, CPI, is at 2.4%. And that does not take into account food and fuel, two of the major factors of inflation. Okay. CPI is just consumer goods, excluding food and fuel. Okay. When you add in food and fuel, we expect those to inflate at more than 5%. Okay. So your average inflation is going to hit around 4%. That's more than what the S&P 500 is expected to return for the next 10 years. Okay. So inflation alone is going to outpace the market. Then you take into effect the tax consequences or tax liabilities at exit. So let's take an individual who, let's say somebody is expecting to retire in 10 years. Okay. And to make it into retirement, they need $3 million. Okay. They're going to retire at 65. They need $3 million, which is in today's numbers, that is incredibly low. Okay. If you want to maintain your lifestyle. Okay. So at $3 million, if you want to retire with $3 million, okay, then at 3%, you're going to get $90,000 a year in growth. Okay. So that means you're going to be, if you're living on $150,000 a year, you're going to be dipping into principal to the tune of $60,000 a year, quickly eating into the overall portfolio that you've built for retirement. So then the question becomes, at what point do you outlive? And that's not taking into effect taxes. Okay. That's not taking into effect taxes, because you're going to have to sell a little bit more. If you want to continue living on 150,000, you're going to have to sell more stocks than just $150,000. You're going to have to hit at about, let's see what in retirement. You're going to have to an extra, so about 180,000. Okay. So that's $90,000 from the growth that the stocks have provided, and then another $90,000 of eating into your principal balance, your retirement balance. Okay. So you start facing the implications of, am I going to outlive my retirement? Okay. And so this is where we've really got to focus on what is the right portfolio for you. Whether you've already retired, you're looking at retiring in the next year or two, or maybe in the next 10 years. Okay. If you're focusing the majority of your portfolio on the market, on the equities market, you're facing a scenario where just your cost of living is going to outpace the growth potential of your portfolio. Then you take into effect taxes and how long are you going to live in retirement? Okay. And so now that $3 million all of a sudden you thought you needed turns into 6 or 7 million. Okay. Unless you have the proper diversification. Okay. So with the hurdle rate, back to the hurdle rate and how we structure our funds, okay, with preferred return. So yes, the hurdle rate, you may not accomplish that in cash flow each year. Okay. But we've got four aspects of growth that we're looking to capitalize on to overall generate much higher returns. And right now, for the first time in 3 years, I'm finally looking at deals again that we are expecting to exceed 20% returns. Okay. And so that's because we're buying at an extreme discount. We're focusing in markets that have strong growth and appreciation. Buying at a discount with lower leverage, we're generating higher cash flow. And then we've got major tax advantages. Okay. And so there's pros and cons to real estate. If you're somebody who is going to need some liquidity, going into retirement, you've got $3 million retirement nest egg. You want some of that liquid in case you have the opportunity to make a different investment that has a huge potential to it, or, maybe there's a medical issue, you need some liquidity. Well, if you tie all $3 million of that up in real estate because you're looking to hit 20% returns, it's not going to have any liquidity. Okay. And so you're going to be at a position to where you may need some of that capital and not have access to it. But somebody with $3 million moving into retirement, looking at placing $1 million of that into real estate, now you've got 2 million that represents liquid capital that you can diversify out within the equities market. Yes, it's going to be very, very slow growth over the next 10 years, but you've got some liquidity there. Then you've got strong earnings potential with that $1 million that has very low liquidity, and it's generating you some tax advantages. Okay. And so it's diversification. So we look at that and say, how much do we need to diversify? But then what I was mentioning is we've got an opportunity or a very short window over the next 10 years or the next 9 to 18 months to set us up for the next 10 years. What does that window look like and why? So I read another article. Okay. And so a lender, Ready Capital. So Ready Capital just dumped $855 million worth of their debt on their balance sheet in distressed loans for pennies on the dollar. Okay. They're looking for operators like ourselves to step in and bail them out. Not necessarily bail them out. They're taking losses, but get non-performing loans off their balance sheet. Okay. Another lender, this was one of our lenders, is sitting on $1 billion, over $1 billion in multifamily delinquencies. Okay. Delinquent loans. Okay. So the extend your loan and not address your loan, the extend and pretend era is over. Okay. Most of these loans, ourselves included, we borrowed 3, 4, 5 years ago. We had 3-year loans with 2 1-year extensions, variable interest rate loans. They're bridge loans. When you buy an asset that has value add, you're going to get a bridge loan. You're going to do the value add, get it to stabilized and you're going to refinance into a permanent loan. Well, when stabilizations were happening at the peak of the interest rates, the amount of loan that you could get decreased. So let's say you bought an asset for $25 million. You got a $15 million loan, bridge loan, okay? $10 million of equity in the deal. And actually, that's a little bit more equity than most operators were putting in during that time period. But regardless, you've got a $15 million loan and you're wanting to refinance at stabilization. But when you got the $15 million loan, interest rates were 3%. When you stabilized the asset, interest rates had gone up to 8%, 7%, or even in today's market, 6.5%. Okay. Now all of a sudden, your debt to equity ratio or your debt service coverage ratio, how much income you make to how much your debt service is, has changed significantly. And so now at a higher interest rate, you're not able to pull out as much loan as what the first loan is. Okay, so your $15 million loan that you've got to pay off, your new loan, you're only getting $12 million. So you've got to come to the table with $3 million. Okay. Now, in our instance, we've been able to do that in most circumstances because we have 750 plus investors. We've managed over $300 million of investor capital. Many operators do not have that capacity and don't have the liquidity in order to do that. Okay. And so it creates an opportunity. The lender then finally gets tired of extending and they step in and they say, okay, we're taking this loan back. And then they start searching for an operator like ourselves to step in. Or the lender puts so much pressure on the operator that the pressure just throws in the white towel and says, I'm done. I'm walking from my equity. You can have the asset. And again, the lender looks for an operator like us to step in. Oftentimes, those assets have another $1 million to $2 million worth of value add to do. They've had deferred maintenance over the last 3 years that haven't been addressed, or maybe even 5 years and it hadn't been addressed. So the property has declined. So we need $1 million to $2 million to put into it. So the lender comes to us and says, okay, I've got this asset. I've got a $15 million loan on it. Okay. It needs $1 million to $2 million worth of work. Well, I know that new lender is only going to give me, well, they were going to give the original borrower $12 million if he could make that deal done. However, since this is a new purchase, it's going to be a little bit less leverage. So we're looking at probably $10 or $11 million in a loan. Okay. So current lender has $15 million loan. We need to put $1 million to $2 million into it. Okay. I'm not paying $15 million for that. I'm going to pay $11 million for it. With an $11 million payoff, new lender is not going to give me 100% of the payoff. Okay. They're going to give me 80%. Okay. So we're going to get $8.5 million loan. We're going to come to the table with $2.5, $3 million plus the value add. So $4 million. We're going to step into a huge opportunity to generate cash flow, huge equity, we'll get to participate in the appreciation in the market that we're buying in, and then tax advantages. Okay. And so we've got a very, very short window of this going on. Okay. Before either all the major hedge funds have stepped in and taken up the good, valuable assets and we're left with what's left over, or we start seeing interest rates really start to take effect and start to right size so that operators are able to refinance. Okay. And so it's going to be very short window. We've already had some of our lenders come to us and approach us with some of these opportunities, and we're looking at 3 of them right now. Okay. This is the first time, like I said, I've seen deals and underwritten deals that we're expecting to hit 20+% annualized rates of, or IRRs, annualized rates of returns, affected for time value of money. Okay, is ultimately what the IRR is. So if you've got a 25% average annual return over a 5-year period, then you apply the time value of money to that. You take the 5 years that it takes to accomplish that and what returns come in that time, and your 25% average annual return hits 21, 22% IRR. Okay, and so this is the first time in 3+ years that I'm seeing opportunities that are going to exceed 20%. Okay. And like I said, it's going to be a very short window. So we've got to take advantage of that right now. So if you have any questions about, what we've talked about today, then you're probably seeing this maybe on YouTube. Comment below, or you're seeing short versions of this on social media like Meta, Instagram, Twitter, whatever the case may be. Comment. Ask us your questions. I look forward to engaging with you. You can also go to our website at lasatercapital.com. That's LASATERCAPITAL.com. And you can schedule a call with myself or my brother or one of our capital managers. And so I look forward to answering your questions. I look forward to working with you. And so if you have any questions about the articles that I talked about, or about a preferred return or a hurdle rate, then please don't hesitate to reach out. This has been the 14th episode of The Growth Factor. So thanks for joining us, and I look forward to seeing you next time.